If you're a guy who always trades based on stop loss and targets, definitely this video is going to be really helpful for you, because by the end of this video, definitely you will stop using targets going forward. Why target doesn't help you in the long run? That is what we are going to focus today. When it comes to trading, many people or many beginners, when they start trading, they always check their overall risk reward ratio potential. If they are risking 100 rupees, they want to make 200 rupees. This is a normal common sense that most of the traders use. But what happens is, why should people use targets? Why are they specifically so focused on coming out with specific targets? See, it mainly because of their trading psychology. What happens is, say suppose you entered into a trade and you enter at 100 rupees and the stock goes to 200 rupees, but by the end of the day when you're trying to close the position, it comes back to, say suppose, 150 rupees. Then what happens is, people psychologically think that okay, it has gone to a certain extent of 200 rupees, but I've lost the overall profits coming back to 50 rupees. If I've used a target and locked my profits, then definitely I would have made profits. And also it makes them feel much better, instead of losing a specific a portion of profits because of the retracement. If they have locked the profits, it makes them feel good. So most of the people go with the targets. And also the second part is, say suppose you entered at a trade at 100 rupees and then you close the trade at 200 rupees with a target. But what if in case the stock goes to 300, 400, 500, 600, even if it goes to 1000 rupees, you feel really bad because you have closed the trades at a much earlier phase. So using a target is kind of a two-way sword. Like what happens, sometimes you feel really good because you close the position at the right time. Sometimes you feel really bad because whatever the position that you have closed would have ended up in a much higher profits if you have held on to that without any targets. So in this video, we'll take a specific trading example. We'll take a specific option trading setup. It is an option buying setup where I'll show you what will be the overall profits if you use targets, and what will be the overall profits if you don't use the targets. So over the long run, over the 5 or 6 years, which one does really well? That is what we are going to see today. On this simple rule, we'll take it. It is like, you take at 9:30, check out whatever the closest premium, any strikes on the call side and the put side, whichever is trading at 100 rupees. At 9:30, look for any strikes which is trading around 100 rupees every day. Okay. Now, if any of those strikes moves 30%, say suppose from 100 rupees, if it goes to 130, then we will buy that strike. So what we are doing is, we are not directly entering into a trade. We will wait for the market to create momentum. If it goes on the upside, then what happens, the call option which we are looking for near to 100 rupees will go and increase, but the put option will not increase, so we will not enter into that trade. So basically you are looking for a wait and trade mechanism or a simple momentum mechanism, where if any of the strikes moves up 30%, we will enter into that trade, and then we will use a stop loss of same 30%. Now exit the trade by end of the day. Simple. So only stop loss is there, entry condition is there, no target is there. Similarly, with the same rules, we will add targets as well. So for the rules, we use stop loss 30%, and in case if we have to use targets, we will use 60%. So it is 1:2 risk reward ratio, where the overall stop loss is 30% and overall target is 60%. So this way, people who are specifically looking for higher risk reward ratio, they have the targets. In the other one, same rules, same entry condition, same stop loss, but no targets. So out of these two, which one would really look well? Let me explain the rules of this specific strategy. So I'm selecting Bank Nifty and I'm entering at 9:30 and closing at 3:50. And the condition for entry for both call option and put option is, look for strikes which is closer to 100 rupees, both on the call side and the put side, and wait for that strike to go up 30%. So if, say suppose, you are seeing a particular call strike at 100 rupees, and only if it goes to 130, we are going to enter into it. So this way you are not directly buying a call option or directly buying a put option, or not directly buying both the options. You're just waiting for a momentum to occur, and once it moves up 30%, we are going to enter into the trade, and we are going to use a stop loss of 30%. In case it reverses, we'll exit it. That's all, no targets. And if you test this from 2017 to till date, this is the overall profits you make. You ended up making almost 2.5 lakhs of overall profits with a drawdown of around 20,000 on an average. So this is our average drawdown, and overall returns you make around 2.82 lakhs. And if you could see, the overall returns and drawdown is very minimal, but if you see the winning accuracy, it is only 32%, which means that if you take 10 trades, 7 trade is going to end up in loss, only 3 trade is going to end up in big profits. But if you see what is the average profit when you are making in a winning trade, like when you are right, how much you make, when you're wrong, how much you lose, that is all matters. So here, when you're right, you end up making almost 1900 rupees. But when you're wrong, you're losing only 650 rupees. So as I said earlier, the risk reward ratio is very, very bigger here. Even if you see what is the maximum profit you could make in a single trade, it is 21,000. And the maximum loss you faced in a single trade is only 4,000 rupees. So overall, without using winning accuracy, I mean without using any kind of targets, you ended up making almost 3 lakhs of overall profits with very minimal drawdown. If in case we apply targets to this, how much we would make? So let's look into that. So same bank nifty, same entry condition, same exit condition. I have given everything same. I have just added target profit 60%, because stop loss percentage we have used 30%. So I'm using target percentage 60 so that we'll get 1:2 risk reward ratio. And we'll run the same backtest for the same period. Now if you could see, overall it has given only around 1.2 lakhs of overall profits, less than what we have seen in the earlier version. So even though the drawdown has gone down from 20,000, it has gone down to only 10,000 drawdown, that overall profit potential has greatly gone down. From almost 2.8 lakhs, it came down to just 1.18 lakhs. So it is less than half of it. And if you could see, the winning accuracy increased from 32% to almost 45%. So there is no major difference. If you are taking 10 trades without targets, you end up 3 trades in right. With targets, you end up taking 4 or 5 trades being right. That's all. And if you see the overall average profit when you're right and average loss when you're wrong, no much difference. The average profit is around or 950 or 1000 rupees, and average loss is around 600 rupees. And the overall risk to reward ratio has gone down significantly, because in the long run, by using the targets, you are limiting your overall profit potential. So this example clearly shows why target will not be really helpful in the long run. So we are in the markets, ask yourself why you are in the markets, whether you want to be right most of the time or you want to make money in the long run. If you want to be right most of the time and feel good about it, then it's better to go with the targets. But it is not about being right or wrong, it is all about making money in the long run. Then do not use targets in the any kind of option buying system. You are limiting your profit potentials because of that. So this is what I want to convey in this video. I'll see you guys next week with another video. Bye.